So the beginning of 2023 was super strong for stocks. I would bet most people watching this video had a great time in the market. They might have hit all-time highs in their stock market accounts in the beginning of 2023. But now over the last 16 days, we've seen quite a big drawdown in the S&P 500. It only looks like about 4 to 5%, but to be honest, 4 to 5% on the index is pretty large as it relates to a pullback, given the fact that about 10% on average is the yearly return of something like the S&P 500. The big question to a lot of people is, why have stocks seemingly done a U-turn from what they were doing in the beginning of 2023? We're going to talk about all that in this video. Before we get into that, my name's Austin. Thank you for being here. I'm a co-owner of cloudsuite.com and I'm a stock market investor. If you're new to the channel and you're not one of those 1,800 or so subscribers, go ahead and click that subscribe button. If you're back, thank you so much. I appreciate you in a major way. As a thank you for being a subscriber, here's a picture of both my cats, Millie and Luna. Millie's the gray one, Luna's the brown one. They thank you for subscribing. Okay, let's back up just a little bit. So at the end of 2022, first of all, if you didn't know that 2022 was an absolutely awful year for stocks, it was an absolutely awful year for stocks. But at the end of 2022, the expectation from so many analysts, if you watch any CNBC, if you listen to any hedge fund managers, is that the beginning of 2023 is going to be super weak. We're not only going to have super weak earnings, but we're also going to have super weak returns. And the idea was stocks are either going to go nowhere or they're going to keep on going down at the beginning of 2023. And the prediction was that the end of 2023 was going to be a great time for stocks. Q3 and Q4 was just going to be flying higher. We were going to see strength. We were going to see a re-acceleration of earnings growth, re-acceleration of revenue growth, etc. And stocks were going to have a great time. Although the year's not over yet, it seems like that's exactly the opposite of what happened, which is hilarious because the beginning of 2023 all the way until July 31st was looking great. We had a 20% gain on the S&P 500. That's not all that insane given the fact that we had such a crazy bad year last year. That's still down from the beginning of 2022, just to be clear, just to kind of put a little bit of context around how bad 2022 really was for stocks. So this big U-turn kind of happened around August 1st. What is something that happened on August 1st? Fitch, which is a major credit rating agency, actually went out and downgraded the United States long-term ratings from a AAA credit rating to a AA plus credit rating. This is only the second time that had happened in United States history. The other time was in 2011 after the 2008 financial crisis. That makes a lot of sense. And now they've done it for the second time on August 1st of 2023. The two main reasons for their downgrades were the erosion of governance as it relates to fiscal and debt matters in the entire government. We were just a few days away from defaulting on our debt for the first time ever just a few months ago. And there's constant conversations of a government shutdown because the two different sides of the aisle cannot make an agreement until the very last minute. So that was one of the reasons for the downgrade. And then the second biggest reason for the downgrade, although they list a lot of them, the second biggest was a general rise in government deficits. We're up past $30 trillion in national debt, and that number is probably not going to get that much smaller, if any smaller at all, over the coming years or months. So pretty much once this credit downgrade came out, stocks started to see some weakness. This was kind of the start of that U-turn. This is not the only reason, but it is one of the reasons. The other big reason that's helped move stocks down is the continued CPI reports that we're going to keep on getting month after month. June, we had a 3.0 print on the total CPI, and in July, we had an increase to 3.2. That's the first increase we'd seen since 2022 as it relates to that CPI number. This was definitely a mixed bag. The core CPI came in lower than expected, and actually inflation came in lower than expected. But it was a rise on a month-over-month basis comparing to June at that 3.0 year-over-year versus the 3.2 year-over-year number we had in July. Although both of those were beats in comparison to expectations, the fear is that we're going to keep on rising from that 3.0 to about a 3.2, up to a 3.4, up to a 3.6, etc., and keep on accelerating inflation through the next few months as we see more and more CPI prints. Is this going to happen? I don't know. I know that the forward rate has rose all the way to 4.83 from a 4% expected that we saw in May as it relates to inflation bond pricing. If inflation keeps on accelerating, the Fed is probably going to keep on raising rates. They signaled that they're going to do one more rate hike, but if we keep getting CPI that's on a year-over-year basis continually higher than 2%, which is the Fed's target, and continuing to rise from the 3% to 3.2 and higher, I would say it's almost a sure shot that the Fed is going to keep on raising those rates. They only have a few tools in their bag, and raising rates is the main tool that they use to bring that CPI number down. So given those two main things, a lot of fear is starting to creep back into the market, which I'm certainly not mad about at all. Around May of 2023, my purchases of stocks fell off a cliff. I was still buying a couple stocks. I was still buying PayPal. I was still buying Upwork. But those are literally the only two stocks I've bought since May. I haven't loved the pricing around a lot of stocks. I haven't loved the pricing around big caps. I want to keep on building my Amazon position. I want to keep on building my Costco position and quite a few others. I just haven't liked the pricing around them. I'm not going to buy stocks I like at any price. I'm going to buy stocks I like at the prices I like, at the valuations that I like. So for the most part, I've just been piling cash in my portfolios. Like I said, I was buying PayPal, I was buying Upwork, but for the most part, my buy orders dropped off a cliff. I would love to feel comfortable back as a buyer in the market. I'm not saying there's no great deals out there right now, but there hasn't been anything that's enticing me in a major way to make me either open a new position or increase my existing positions. So a little bit of pain in the market, a little bit of a market pullback. I'm totally happy. I'm cool. If that happens, I'm ready to go. I'm ready with cash on the sidelines to scoop up any major dips in any of the companies that are either on my watch list that I'm looking to build a position with, or companies I already have positions with that I want to grow bigger and bigger. Is it time to panic? Is it time to freak out? Is it time to sell your stocks? That's all up to you. As a long-term investor, it's always better to stay invested. I think by now we've all heard the statistic that if you miss just the 10 best days in the market, I mean singular trading days, if you're not invested in those singular trading days, something like the 10 best, you would have cut your stock returns in half. So getting in and out of stocks is almost always a loser's game. Some people are great at it, some people are beastly day traders, but the amount of time it takes to actually be a consistent winner is so outsized in terms of the amount of return that people would get as a result of day trading. Jumping in and out of your entire portfolio, jumping in and out of specific stocks, trying to time the market, it's so stressful. It's not my personal game. I'd rather choose to buy companies I love at great prices and hold through potential pain, add more shares if they're dipping. As long as those company fundamentals are getting better, the revenues are increasing, the net income's increasing, ideally more than revenue. We've got free cash flow and the balance sheet's in a great spot. The total addressable market that company plays in is expanding and they're growing faster than the TAM. Those are companies I'm going to be picking up. That said, I'm not going to pick them up at any price. Pricing is so important in the stock market. I always want to make sure I'm getting good value for the hard-earned money that I'm putting into my stocks. So I don't have any shorts out there. I'm completely long on the market, but I do have cash on the sideline just in case we continue to see a lot of price depression in equities over the next few months. I will happily welcome a fear-based drop in stocks because fear-based drops are not fundamentally focused. I am fundamentally focused. I am worried about cash flows. I am worried about EPS. I am worried about growing revenues. I'm worried about the management team executing on a quarterly basis. I'm not here to listen to all the fear and noise out there. I'm also not here to listen to all the hype and hopium. And when we're flying to the moon, I'm not just going to jump on the train and try to fly to the moon with everyone. So if you're still thinking about timing the market and jumping in and out of stocks, I'll just leave you with a quote from John Keynes. The markets can stay irrational longer than you can remain solvent. Do with that what you will. I want to hear what you're doing out there with your stocks. Let me know in the comments. That's definitely my favorite part of posting here on YouTube is seeing those comments. I try to reply to as many as possible. So get down there and let me know what you're doing. Thank you so much for being here and have an amazing day.